The average American owes $5,525 in credit card debt at a ridiculous 21.62% interest rate. It'd be nice to cut that interest rate in half, wouldn't it? Well, I'm happy to say you can. Overnight, even. Several companies offer low-interest loans to help you consolidate debt and save thousands of dollars. So, if you're looking for the best personal loans for bad credit scores, don't worry. I've got you covered. But first things first, what even is a bad credit personal loan? Well, as the name suggests, it's a specialized loan for consumers with suboptimal credit scores. These loans usually come with a fixed interest rate, so you won't have to worry about interest rates increasing, which is nice. Plus, most banks provide loans for bad credit, so you'll be able to consolidate debt or pay for an emergency with ease. There's an easy 5-step process to help you qualify for a personal loan in no time. Step 1. Choose your loan type. Most people think that there's only one type of bad credit loan. Thankfully, there's various types of loans for bad credit that you'll have options to pick from. Find a loan that is tailored to your interest rate and payment plan needs. I'll deep dive the different types later, so keep watching. Once you've chosen your loan type, it's time to compare lenders. I know, it can be daunting. So, to save you from pulling your hair out, I've come up with a list of the best loans for bad credit. Check the description. Now that you've compared lenders, it's time to pre-qualify. Most lenders will allow you to complete this process online, and they'll give you an idea of what to expect for interest rates, loan amounts, and repayment options. You also won't have to worry about this harming your credit score because most online lenders only do a soft check instead of a hard credit inquiry that would show up on your credit report. And yes, pre-qualifying doesn't guarantee a loan, but it gives you a good idea of what's available. Before you apply, consider getting a cosigner or offering some collateral. I have to say, this step is optional for some loans, but it can increase your likeliness to qualify substantially regardless. With a cosigner, someone else's income and credit score is added to your loan application. The cosigner takes responsibility for paying back the loan if you can't. This gives the lender a safety net, so it's easier for you to qualify. Another option is to offer collateral like a car or savings account. It helps you qualify because if you can't pay your installments, lenders will be able to use the collateral as a payment alternative. When completing your loan application, you'll have to gather documents like personal identification, proof of income, employer information, and proof of residence. Yeah, this can be a hassle, but it's necessary to determine your ability and likelihood to pay back the loan. Fortunately, most lenders will let you know whether you're approved or not the same day. So now that you know the process, let's dive into the types. As you might have gathered, not all loans are created equal. Here are the most common types of loans for bad credit. Secured loans are backed by collateral. So while collateral is an option for some loans, that's not the case here. This ensures the lender makes their money back if the borrower can't pay. These loans are usually easier to qualify for and often have lower interest rates. Unsecured loans are a form of personal loan that doesn't require collateral. Instead, banks rely on a borrower's creditworthiness, credit score, credit history, and income. This is riskier for lenders, so the interest rates are usually higher. Joint personal loans are similar to co-signed loans. They allow people to qualify for larger loans and better interest rates because both parties are responsible for the loan, not just one person. Payday loans are for small amounts, typically a $500 limit, and are repaid in a single payment within a month of when the money was released. The nice part about payday loans is that they don't require credit checks, and the money is often disbursed immediately. Cash advances are short-term loans that allow you to borrow cash against your credit card limit, often at a higher interest rate. Just be aware there is typically a fee to use this service. Bank agreements are when your bank approves you for a short-term loan or agrees to a limited account overdraft. This is for people who have a good history with their bank and isn't available at all banking institutions. Home equity loans are when you need a lot of money up front, so you put your house down as collateral. Some people even use home equity loans to make improvements on their house to increase its value. Just beware that if you default, you could lose your home. Also known as a home equity line of credit, an HELOC is similar to a home equity loan because they use your home as collateral. However, an HELOC functions more like a credit card. Borrow only what you need, up to a limit, and repay the balance plus a variable interest rate. Hopefully one of those sounds like a good match for your needs. I'm confident you'll find an option that's right for you. And I'm crossing my fingers you get approved. For more credit and money resources, make sure to subscribe and check the description for some of my favorite links.